Welcome back to our second session of the day. The session is entitled On Par, a Money View of Stablecoins. And this is actually co-authored between Iñaki Aldasoro and Dan Neilson. I believe Perry as well has been involved. Unfortunately, Iñaki cannot make it today because of a family emergency. So we will rely only on Dan to present this BIS working paper. And obviously, you know, Dan, the most important contribution of late has been his book on Minsky that he published, I think it's now almost 3 years ago, and was the very first book we read in the Money View reading group. And a regular visitor. Great. So Dan, I would like to just hand the floor over to you. We have an abbreviated schedule today, fortunately for you, but some discipline will do us good now to run through this quickly. Thank you. The floor is yours.
Thank you very much, Jay. Let me just ask if audio and screen sharing are okay. It's good. Thank you very much for having me, Jay, and thank you to all of you for being here. I have been a part of all of these Money View symposiums very gladly. I really appreciate this audience, and in fact, the global nature of this conversation is one of the important pieces of it for me. And of course, having a global simultaneous conversation is amazing, and it does mean that some people are up in the middle of the night. It's just a little after lunch where I am, but I thank those of you who are in inconvenient time zones relative to this particular moment in time. And the benefit, of course, is that we get to talk to each other live, which is very cool. So I'm talking about this this paper, which is a collaboration of the three of us, Perry, Iñaki, and myself. This paper is available as of end of 2023 as a BIS working paper. Maybe someone could post the link in the chat just in case you haven't seen it. The paper is On Par, a Money View of Stablecoins. On Par, of course, is a little bit of a pun because par, of course, is one of the prices of money, which we'll be certainly talking about in this paper. But you know, it's also a sort of a golf reference indirectly. We don't have anything to say about golf, but on par. And as Jay said, Iñaki is not able to be here for a family emergency. Iñaki sends his regrets, and he's been part of this conversation in the past and was looking forward to it today. So we're sorry not to have him with us, but we'll report back to him how the conversation goes, and keep him in the loop that way. It's been a very fun collaboration. In fact, I want to say to this crowd where Iñaki and Perry and I are all known quite well, I think. It's been a fun collaboration because really took all three of us, and we brought different things to the table. And the paper that has come out of it really does represent all three of our voices, but speaking together, I think, and I'm going to do my best to represent that here today. I was planning until quite recently to have to be able to tag team with Iñaki here, so I hope you'll forgive me if I'm organizing my thoughts a little bit as we go. I am, before I get into it, I'll just say I'm happy to be part of this event, and of course, Perry and I are collaborating on the fourth price of money paper that we just heard about. I'll be back again tomorrow for a couple of the sessions, one of which I will mention a little later on. Unfortunately, I won't be able to be at everything, and I just want to say that I'm very excited to be part of this conversation, and I'm excited to hear from everybody. I cannot physically be here all weekend. I have some other things that I'm going to have to do, but I'm certainly available to be in conversation, especially for those of you who are working on topics that touch closely on things that I have worked on. So please do reach out. I'm just trying to say, please, it's not personal. If I'm not able to make it to your session, it's just because I have other things that have to get done. But I'm here. So, stablecoins, a money view of stablecoins. We set out to write a paper that would speak to a couple of different audiences on the question of stablecoins. Stablecoins are a set of crypto tokens. They are money-like crypto tokens, and they have some important characteristics that make us think of them as money-like objects. And so there's some newness, some novelty to them, in the sense that stablecoins have only existed for a few years, and they come to us through this sort of crypto world, which is dates back to the 2008 crisis, but really a lot of the action was in 2020, 2021, and 2022. So stablecoins are new in that sense, and coming as we did from the money view perspective, we felt sure that although there's something new here, which we won't deny, we felt pretty sure that our analytical frame would be able to handle this question of stablecoins. What are they and what should we make of them? And that we already had the apparatus that we needed. And we had to learn some things, but we did not have to change our fundamental perspective. And that was reassuring, and it helped us learn a little bit along the way. So I'll try to share some of that with you. The purpose of the paper was to speak to one another, first and foremost. Harry and Iñaki and I worked together on this over some time, and had to learn how to communicate, among the three of us about this question. But then, as we reached for larger audiences, Iñaki in particular works at the BIS and was concerned to be able to speak to the central banking community, in which part of the point is to give them a reason to think a little bit about the money view. Iñaki felt he certainly works with something that he would consider to be a money view, and has participated in this event in past years. And there's sort of an implicit money view in a lot of central bank BIS publications, but not universally, and especially when talking about crypto, the perspective can often be missing. So one of the purposes of this paper was to illustrate the money view to that audience. I'm not going to try to illustrate the money view to this audience. I think that's not necessary. I gave a version of this presentation while I was a visitor at the BIS in Basel, Switzerland, in the BIS seminar, internal research seminar, which was great. And they have very exacting standards. The whole thing has to be 30 minutes, and you have to make your point within 10 minutes, or else everybody gets up and leaves. And I thought it went okay for my first one. It went all right. I'm giving a version of that presentation in a different order, but for this different audience. I think I can get through it quickly enough for the circumstances. So to jump into stablecoins, these are crypto-like tokens, and if we think of them as financial instruments, then like any financial instrument, we need to understand what is the balance sheet operations that make these things work. A stablecoin, described by the crypto types who create these things as crypto tokens whose price is meant to stay fixed at one, and that fixed price of one, of course, we already had a name for that, which is par. Crypto types tend not to use that term, but that is the name for the thing that they're talking about. So we suppose there must be some balance sheets behind this, and how do those balance sheet operations help to sustain par clearing? How do they help hold that price fixed at one, which is not an automatic thing, as we know. In fact, a lot of work goes into it. Roughly speaking, we can find three different mechanisms, structures, financial structures that have been tried out in the stablecoin space to try to hold par clearing together. And you can interpret these in a few different ways, but roughly speaking, we can fit everything into these three categories. The safe assets strategy, which is typical of Tether, off-chain assets like treasuries, and on-chain liabilities, their own Tether tokens, and so there have been many questions about what exactly is in this balance sheet. It's not all treasuries anymore, but you can get the same result with commercial paper or what have you. A second strategy, an entirely on-chain strategy, so on-chain assets and on-chain liabilities, typical of MakerDAO's stablecoin, the DAI token, where on the asset side is crypto collateral. So it's actually crypto assets on both sides of the balance sheet. And this is understood in the community to be riskier. And because those crypto assets fluctuate in value by more than treasuries tend to fluctuate, or more than commercial paper tends to fluctuate. And so I show it on the liability side with some kind of margin, an equity type entry that can expand and contract in value to absorb the fluctuation in value of the collateral and keep the tokens, the stablecoin tokens themselves fixed at 1. And a third approach to stability, algorithmic stablecoins, which is largely a discredited idea at this point, following the disaster around the Terra Luna protocol, which I'll come back to in a minute. Basically is discredited, but the thing is that I think it's not discredited in my understanding of the conversation about this. The algorithmic stablecoins are discredited, but not for the right reasons. I actually think that in that the conversation around how these things worked, there was not a sufficient airing of how the mechanisms worked and therefore how they failed. So people saw that it failed, and they saw that, and it's easy to observe that Terra doesn't exist anymore, and its creators being pursued by legal authorities. But there's an economic idea which has not actually received full airing, and so even if no one tries to recreate a stablecoin, I think that idea is actually still present in other DeFi projects, and needs a little bit of attention. Because I think the idea is not really going to work, hasn't been fully tested in a way that shows everybody what the problem is. So from our point of view here on the balance sheet page, we can see that these protocols exist in a substantial way with no assets. They're liabilities only. And a priori, I'm not prepared to reject that out of hand. I'm open to new ideas. But as we'll see, the algorithm that was supposed to make it work does have an inherent and fundamental flaw, and that was predictable and predicted by people on this call. And so that idea needs to be examined. I'll get to that again in a minute. For the moment, we could say these are stable coins. We can draw balance sheets for them to understand more or less how they work. We can think about the trading in stable coins using familiar analytical approaches and language that we had already before anybody first used the word stablecoin. And so this is not to say that we have nothing to learn, because always people come up with new ideas, and of course there's things to figure out. But it is to say that most financial ideas are not new; they're old, and they already have names. And the question is really mostly just how to rearrange them in a new way to speak to issues that are ahead of us right now. And one of the points that I want to emphasize as we go, no surprise to this audience, is that all of these stablecoin mechanisms really, in the end, are about market liquidity. That the question really is, stablecoins are money-like objects. They're created to serve the need in the crypto space for a payment mechanism, for a token which can serve to complete payments. That's why you need money. Same reason that you need money elsewhere. And so the real question is, can you use these tokens to generate cash flow, to satisfy payments on contracts, and so the question really reduces in the end to one of market liquidity. And this is a point which is not commonly recognized in the sort of crypto internal discourse. And I'm not sure that they all listen to us either, but it doesn't hurt to try. So let me start with a couple of I these days I'm very much a data guy, and so let me just start with a couple of empirical observations from the paper around the stablecoin phenomenon. It's very exciting. I have to say, it's very exciting to be able to use graphs in our own graphs, and recognizable in the BIS format. And Iñaki was responsible for turning our various things into things that look like BIS graphs. Here we have the prices of a couple of stablecoins around the collapse of Silicon Valley Bank in March of last year. Note the timescale. We're very zoomed in here. This is a minute-to-minute kind of picture of this for stablecoins. Breaking the peg, and the vertical line at A marks a disclosure by Circle, issuer of USD coin, that $3.3 billion of their cash reserve was held at Silicon Valley Bank. So Silicon Valley Bank, obviously, not only a crypto bank, but part of what was going on here was its close connections to the crypto space, and this Circle reserve was a piece of that. So the Circle is the yellow line, which is the one that falls first after this disclosure at the vertical line A. And the sudden question of $3.3 billion of their reserves was enough to create a pretty significant gap between Circle's price and their notional peg of 1. An interesting fact here is that DAI, the blue line, which falls just a little bit behind, it's minutes behind, right? It's not a long time, but just a little bit behind USD coin. DAI, as we know, is an entirely on-chain stablecoin, but on its asset side, on DAI's asset side, it turned out were actually USDC. So one of the crypto assets that was meant to be backing DAI was USD coin. And so here, those of us on this call are accustomed to thinking about a hierarchy of money. At least in this moment, we can see a hierarchy of stable coins where USD coin holds its reserve off chain at Silicon Valley Bank. DAI holds its reserve on chain in the form of USD coin tokens, and so things are lining up into a nicely recognizable hierarchical structure. How was that problem solved? It was solved by the Fed with the BTFP liquidity program. And so let's just remember that the thing that eventually resolved this was a liquidity intervention from the top of the hierarchy. And the top of that hierarchy is quite a ways away from this picture that we're looking at here, back in the off-chain standard U.S. commercial banking system, where liquidity was provided, and some of that flowed through the FDIC, and SVB received treatment that protected the liquidity of its depositors. And so it's a strong initial argument for the statement that payments liquidity, that market liquidity, the ability to complete payments at par, is the fundamental question underlying these stablecoins. We zoomed in on this part of the graph, but not too long after these coins were able to all restore their peg. Note, at this particular moment in history, Tether was not perceived as being all that exposed to the disruptions coming out of SVB. So at this moment in time, Tether's peg was disturbed, as you can see, the red line hovering close to 1, but not perfectly stable on 1. Less stable than you would expect from a par instrument in other parts of the financial system. So let me leave that. But the thing is that so at that moment around SVB, Tether was perceived as the safer bet. One observation we came to over the course of the study was that the stablecoins are not arranged among the stablecoins themselves. They're not arranged into a fixed and permanent hierarchy at this moment. So the idea of hierarchy certainly is present and operative. It's not the case that we can say for sure that Tether is above Circle, is above DAI. It doesn't always work that way. So here's some evidence for that. Around the Terra USD collapse in May of 22, at that moment, Tether was perceived to be the riskier object. These graphs showed not price, but change in market capitalization. So we're talking about a flight to safety. And so around Terra, Tether was perceived to be the riskier option. And so you can see on the left-hand panel here, a significant move away from Tether and towards USD coin. On the right-hand side is the same the same SVB moment that we were just talking about on the last slide. And here the flows go the other way, out of USD coin and into Tether. And that moment, the perception of Tether was that Tether was the perception was that Tether was safer, and USD coin was riskier. So I think the message here is that there is certainly a sense of hierarchy, and there is a sense of stability and moneyness, but is not unchanging. The notion of a money hierarchy and perhaps a sub hierarchy within the crypto space is very helpful to us and is an important part of understanding what's going on here. And also, let's not be too rigid in thinking that we can narrowly and permanently arrange things into one unchanging hierarchy that answers all of our questions. I think we're not at that. Throughout this whole investigation, I do also feel like we've had to take stablecoins a tiny bit more seriously than we really want to, and that speaks to also some of the feedback we received on the paper, including from some folks who are here with us today. We've had to say, all right, well, let's take this idea seriously and understand it as best we can, starting from the terms on which stablecoins describe themselves, and then working back towards familiar financial ideas to see what is new and what is in fact quite old here. There is a question of whether it's even worth giving them the attention that we have, but it's our view that we thought they would go away a lot sooner, and they didn't. Maybe they still will go away, and that motivated us to want to get the paper out sooner rather than later. But we do think there's enough question here about par and about how the system is put together and how it's grown and shrunk over the last couple of years. But there's enough to say, and sometimes we had to take stablecoins seriously in ways that they did not even take themselves seriously, and we'll see a couple of examples of that as we go. I want to talk for a few minutes about Terra. I mentioned it before, and I want to just take a couple minutes here to go into our analysis of exactly what happened during the Terra collapse. And I think this is of historical interest. In terms of Terra Luna itself, that protocol is defunct, and that happened in May of 2022, as you can see in the picture here. The protocol is defunct, but the idea is not quite dead yet, in fact. And so I keep putting out Terra USD as an example, and I haven't gotten any questions about it. So I haven't had a chance to really explain it. I'm taking the privilege of being invited to give this talk, and I'm going to take a couple minutes to go into the details on Terra, just for the record, because there's an important idea that is not understood by advocates of automated market makers, of which I would say Terra USD is an example, although they don't usually group them together. The same basic idea is there. This is an algorithmic stablecoin, Terra USD, meaning that it was meant to hold par without requiring any discretionary intervention. That is set up as a protocol, which is operated through code on a blockchain, which was intended to hold a fixed price of 1 without anybody having to manage it. How did it work? In fact, there were 2 tokens, a Terra token, which was the stablecoin itself, meant to hold a fixed price at 1. And on the left-hand side of this graph, the upper line, the red line, you can see clearly that at least sometimes it did seem to function reasonably well. And another token called Luna, whose price was meant to fluctuate, and that seemed to work too. Of course, when you try to issue a money-like claim, the fact that you can make it work on 99 days out of 100 might lead you to be very confident in what you are doing. Unfortunately, as any historian of financial crisis knows, everything happens on the other day, and that really is the day that you have to be careful for. Terra USD's design was flawed in a way that was predictable and was predicted, and you could see that more or less what was going to happen is you could see it coming quite a ways away. Let me show you in balance sheets very quickly. The Terra protocol was based on blockchains. It used only liabilities, so there were no collateral or underlying assets intended to support the fixed price. In this set of balance sheets, I just want to walk through quickly how the mechanism was meant to work when the price of Terra USD coins, which were meant to be fixed at par, but were allowed to fluctuate. So if they were to fluctuate below par, then what was supposed to happen to bring them back into par? And the answer is spelled out in balance sheets here. So we imagine Terra USD tokens trading below par. I have them at 90 cents on the dollar, which is a big deviation from par, but the number is just meant to mean meant to mean below par. Those tokens are liabilities of the Terra protocol, as I have them here. I say that because they function as liabilities. They're money-like claims, and they circulate in the hands of other people. They're certainly assets for the other people, and like other money-like claims, therefore, I would say these Terra tokens were liabilities. Legally speaking, I think they're not really contracts that could be argued in courts, and there were no assets behind them. So I admit they're not great liabilities. But when I want to put them on the balance sheet, I certainly put them on the liability side. We could debate the meaning exactly of what liabilities is here, but that's certainly the side of the balance sheet that they go on for the Terra protocol itself. If we imagine these so the who holds them as an asset? Well, lots of people can, but in particular, miners who contributed computing cycles to the Terra protocol. Well, what's the point? When Terra USD tokens are below par, miners can redeem them to the Terra protocol in exchange for Luna tokens, and they can do this in an automated way. And this is the algorithmic nature of this protocol. There's nobody sitting at Terra making this happen. It's written into the code, and miners can figuratively speaking walk up like an ATM can walk up to the ATM, deposit their Terra tokens, and receive Luna tokens in return with no discretionary human intervention by anyone involved at the Terra protocol. So this happens only whenever miners want to redeem. They can do it automatically using the Terra protocol, which is part of why things unwound so fast. The key point is in the price of redemption, because these two tokens are traded at different prices, and Terra is meant to be fixed and Luna is meant to fluctuate. So when you redeem your tokens, your one Terra USD token, what does the algorithm give you? What it does is it watches the market price. The algorithm watches the market price of Luna tokens. And for every one Terra USD token that you redeem, it issues you back 1 over P, a quantity 1 over P Luna tokens, which means it's issuing you $1 worth of Luna token for every 1 Terra USD token at the current market price of P for Luna tokens. So in theory, in the theory of the designers of the Terra protocol, this mechanism is making holders of Terra USD tokens whole. It's paying them $1 worth of stuff for their tokens whose market price has fallen below $1. So far, so good. So far, so good. And I called this, I initially sketched out this, a version of this argument in a post on Student Parted, my newsletter, which was called Division by Zero. Division by Zero rings in my mind from when I was first learning to program computers, because there's an error message my computer would give me if you accidentally put 0 in the denominator of a function that you have written in your computer program. And I thought to maybe communicate with the crypto types who design protocols like this, that it might catch their attention in a way where they could see the error that they have made. One way to see that error is that they put P in the denominator of the redemption function here for Terra tokens. So the issue is what happens when that P goes to 0. In the design for the protocol, once somebody has Luna tokens, they're meant to be able to, this is how it's meant to work. You're meant to be able to sell them at P and get back $1 in bank money. So those are the balance sheets. Of course, it didn't work. It didn't work, and I'll go back here. It didn't work because at the critical moment, nobody wanted to hold Luna tokens. The whole mechanism is built around the idea that you could redeem your Terra tokens for Luna tokens and then sell the Luna tokens for money. But people with money didn't want to buy Luna tokens at the key moment. You can see that in the blue line, which starts to collapse a few days before, as around May 6th, as people start to have some doubts about the Terra Luna protocol. The price of Luna tokens, which have been somewhat stable, begins to fall. The Terra token has a little blip on May 8th, and then by the end of May 9th, really starts to fall. What was happening there was the price of Luna tokens. People held a significant amount of funds in these Luna tokens, but they were more and more worried about the protocol. They were selling the Luna tokens. So P, the value of P, was falling, plummeting close to zero. The protocol was issuing new Luna tokens as people were trying to redeem their Terra tokens. But that number was going to zero, so the number of Luna tokens was going into the billions and trillions as the price P went to zero, and eventually confidence in the whole thing collapsed. So there's the story, and Terra is really no more. The point I want to make here is that I said division by zero. That's a message to the computer types who might be reading this. You can't put P in the denominator because it could go to zero. You're going to have problems as it goes to zero. For those of us on this call, we might also say that there's a liquidity, that you've missed market liquidity here. Because the reason the price is going to zero, or an equivalent statement to Luna tokens going to zero, is to say that nobody wants to buy them anymore. This whole algorithm makes sense if there are always buyers for Luna tokens, which means that they've assumed the existence of market liquidity for Luna tokens. That assumption, at the one moment when it mattered, clearly didn't hold. Quite predictably, didn't hold. And so there was no one to buy them, and the protocol fell up. I'll leave the discussion of Terra there for now. Happy to talk about it with questions if people have questions later or after my talk is done. I'll just say that this idea of putting price in the denominator is also present in constant product automated market makers. And so people are really resting on the zeros and infinities there to keep the price within bounds. It's not going to work if there are no buyers or if there are no sellers. And that is a statement about market liquidity. Let me move on. Back to our the broader picture of our paper. So we've come to stablecoins, which use these different mechanisms, and we have a lot of apparatus and a lot of experience and three different perspectives working on this paper. We wanted to say, how can we make some progress on stablecoins? And we were reading a large and growing literature looking at stablecoins, and lots of folks, we share something with each of these authors in the sense that we wanted to try to map behavior of stablecoins onto other more familiar financial objects. And so if you look around, you can see stablecoins compared to money market mutual funds, ETFs, wildcat banks, casino chips, fixed exchange rates. All of this stuff is out there. And we said, well, the people who are writing these papers that make these different comparisons, when they do that, each one of them reveals something about what prior understandings of the monetary system they bring to the analysis. They've got some theory already in mind, then they look at stablecoins, and then the next thing they say is stablecoins are like X, and the reason they choose X is because they already believe something about the financial system. And we have at least some shared perspective with all of these folks, but we said to ourselves, there's not a money view of stablecoins yet. Our fixed monetary priors, not quite fixed, our invested monetary priors, the place we're coming from is the money view. That's the name we give to it. And so where would those priors lead us in thinking about stablecoins? And we came up with an answer, which is offshore dollars, which is a contribution we are adding to this paper. Let me say at this moment very clearly, we're not the only ones in the world to have made this comparison. And a few people wrote to us afterwards and said that they thought we should have cited them because they had made the comparison. it is true. But most of them have thought about Eurodollars a little bit differently than us. And I do think the way we've cast Eurodollars here, the money view lens we've taken on offshore dollars, is really pretty different than most people. There's one exception to that, and that exception is Luca Fantacci, who in a paper that we were not aware of until after this was done, or at least I wasn't, and my co-authors did not mention it during our conversations, so I assume they were not aware of it either. Luca Fantacci wrote an excellent paper thinking about stablecoins, central bank digital currencies, and global dollar hegemony, which the paper serves quite a different purpose. It's really not the same paper at all. But the reason that he uses Eurodollars, that he and his co-author use Eurodollars, is actually quite close to ours. And so when I learned this, I was very excited. I've had a couple of conversations with Professor Fantacci since then, and I invited him to come tomorrow. And so I would urge you all to join me tomorrow. And I'm forgetting the time at this moment. Someone maybe can throw it in the chat. But I will be interviewing Luca Fantacci about his paper from early 2021, and sort of the conversation will be an update to the paper since several years have passed since then. But we've had great conversations, and it's really a very sympathetic perspective. And so I'm happy to be in conversation with him. He likes this paper as well. So I'm sorry we didn't know about it before, but I'm glad to have started this conversation with him as a consequence of it. So that's just a plug for my session tomorrow. Let me follow our paper for now. We're thinking about stablecoins as connected in some way to, or analogous to, in some way, to offshore dollars. And the one key message, if you want a memorable phrase on which to hang your memory of this paper, I'll say it like this: on-chain is like offshore. On-chain money is stablecoins, and that's like offshore money in the non-crypto world. Offshore money, offshore dollars, which we call Eurodollars. On-chain is like offshore. So that's what I would ask you to hold on to. These statements, I think, are uncontroversial in this crowd. But let me just say very quickly, how do you bring a money view lens onto thinking about stablecoins? Well, I think the way that you do it is to remember that banking is about payment, and stablecoins are the way that you make payment on chain. Banking is about market making, and so stablecoins trade in markets, and their prices fluctuate in markets, and they're designed in various ways, more and less successful, are meant to intervene in that market making in such a way that the price is steered to stay at par in ways that are quite familiar to us from the off-chain world. And monetary systems, of course, are hierarchical, and so we come into it with the presumption that the system is not flat, and that things are more and less money-like, and that the shape of the hierarchy is going to tell us a lot about what's going on and how it works. Again, as I've already said, the hierarchy is not a permanently fixed thing. It's a consequence of institutional behaviors and fluctuates and changes over time in response to events, in response to innovation, in response to regulation. So it's the idea of hierarchy that we always come back to. The nature of the hierarchy at any moment in time has to be understood from context and institutionally. And crypto hierarchies are more flexible, more changeable than the longer established hierarchies off chain, which are also subject to change, of course, as history goes. So I say this because in some of these conversations around this paper, I get the sense that people might have an understanding that hierarchy is meant to always be fixed, that the arrangement of things into hierarchy is meant to always be fixed. And I just want to be clear that the idea of hierarchy is fixed. The shape of the the construction of the hierarchy at any moment in time is subject to change. And this picture, again, I think doesn't require a lot of explanation here. Simply a reminder that moving up the hierarchy, in general, we're thinking of smaller quantities at the top, supporting larger quantities at the bottom, a relationship between discipline and elasticity. In this paper, so not for this audience, but in this paper, we were one of the functions of the paper was to explain the money view to people that we thought could use, that we thought would be willing to listen once we were talking about stablecoins, they might hear us also on the money view. But they sort of came for crypto, and we gave them money view. And so we did explain some of the big ideas along the way. We say that off-chain is like that on-chain is like offshore. That stablecoins are something like Eurodollars. And here, let me make one important point, which is that the way that we think on-chain financial claims are something like offshore financial claims has to do with the institutional arrangement within which those claims exist. So on-chain is a different institutional space, different regulatory space. There's a cost to moving from off-chain into on-chain. There's a cost and a lag and different preferences even. And there's an interconnection among assets on-chain. So for example, stablecoins and DeFi project, you have to buy Tether in order to put money into a DeFi project, because stablecoins are the native money, the native form of money-like claim for other kinds of riskier on-chain speculation. So all of this is very much like offshore, where if you want to spend your dollars, if you have dollars offshore and you want to spend them onshore, then you have to first move them into for the dollar, you have to move them into the U.S. financial system, which means crossing inside of the regulatory boundary from offshore Eurodollar claims, which are loosely regulated or unregulated, and sort of not within the normal purview of the Fed's operations, into an onshore claim, which is very much within the monetary domain of the Fed. This is the way that we think Eurodollars and stablecoins are similar, and I want to be very clear here that the Eurodollar system is older, is much more established, is very low risk, and is conducted by institutions that, even if their dollar business is not strictly regulated by the Fed, they're highly disciplined institutions which may be subject to other regulation by other bodies, and which are doing a very large and very professional monetary business, whereas stablecoin issuers are much less well put together, let's say. There's no reason to think that they're highly stable. There's no reason to think that they have good business practices. Their transparency is extremely low, and the risk of losing one's shirt in Tether really seems non-negligible. So the comparison, we're not making that comparison. We are not trying to say that stablecoins could replace Eurodollars or are institutionally somehow equivalent to Eurodollars. Not at all. And the comparison would break down if you tried to push it in that direction, because they're not the same. The similarity has to do with the fact that moving between onshore and offshore is very, very similar to moving between on-chain and off-chain. This leads us to consider the just how is the offshore dollar system put together. And so now here we're thinking, we've established that we think that stablecoins are something like Eurodollars. So now let us go to Eurodollars and think about how things work there. And so here comes the sort of key monetary theory intervention in the paper. How do Eurodollars hold par? Well, the way it works is through a set of interest rates, very well developed, highly liquid markets, set of full term structure, right? So you can borrow and lend at all points in the term structure, offshore, and you can move money onshore and offshore. Now, usually you can do that at par, but that's not an accident, and it's not something which is simply declared to be true. There's in fact a lot of mechanism which makes it true. And so the way that it works, as we say here and in greater depth in the paper, is that we're trying to hold a spot exchange rate, so to speak, between offshore and onshore dollars, trying to hold the spot exchange rate fixed at 1. But interest rates, so a forward price of offshore money, are allowed to fluctuate to rise and fall over time, and the fluctuations in those interest rates create an incentive to conduct forward transactions in Eurodollars, and therefore to reward those who have a surplus today can pick up an interest rate premium by transacting in forward markets. They can pick up an interest rate premium, which is compensation for delaying their redemption. Let's say their redemption of their offshore dollars onshore. If they can put that off for a week, then they can pick up a few basis points of profit. Or if someone is expecting a surplus in a few days, perhaps in the other direction, they can pick up a few basis points of profit by lending and borrowing today in the other direction. So the spread between onshore and offshore interest rates creates a profit incentive and an arbitrage opportunity that steers holders of surplus funds at different points in the term structure, creates a profit incentive for them to move those funds back and forth in time, including all the way to the present, to resolve imbalances today using surpluses and deficits farther out in the future. This is the function of highly liquid, fully developed markets across the term structure, and it has the effect of keeping the current redemption price of offshore dollars fixed at 1. And in fact, this mechanism is extremely successful, and so much so that one hardly even notices that there's a price there, right? And so part of the work of this paper is just to remind people that par is a price, that the price is 1, and in something like Eurodollars, you could forget that there's even a variable there because par, the whole system works very well. But just as in stablecoins, there is the potential for fluctuation there, and there's actually something happening which prevents that. What's happening is a lot of action in forward markets governed by interest rates, which fluctuate to create arbitrage opportunities. So taking the pressure off of par, putting it somewhere else, and the gap in interest rates creates the profit incentive, which leads someone to want to harvest that arbitrage opportunity and therefore absorb the mismatch flow themselves. There's a limit, of course. There's always a limit, but even in the limit, we have seen the system show how it holds together. That limit, one way to see that limit is during the 2008 crisis, and again during the beginning of COVID, where the smooth functioning at par of the Eurodollar system broke down, and the Fed has come in using the FX swap lines, which are a mechanism using the network of central banks. The Fed can create, in both cases, hundreds of billions of dollars of Eurodollars. In fact, right, they're dollars held offshore, by creating onshore deposits for other central banks, who then create offshore deposits for their own banking systems. And so when the private Eurodollar system can no longer hold par on its own, the Fed has repeatedly recognized its obligation in supporting the global dollar system. The FX swap lines are the key to that. At that moment, so I don't have the swap lines themselves here, but we do have some data on the dynamics of Eurodollars around that moment. So let us look. Let's take the right-hand side first. This is a measure of Eurodollar deposits, global offshore dollars, in the years leading up to the 2008 crisis. This is not a perfect measurement. There is no perfect measurement of Eurodollars, given that they're a private instrument. But Iñaki and I worked together on getting the best measurement that we could using BIS data, and so I'm pretty confident that the story is correct here. It's a gigantic expansion of offshore dollar holdings in the years leading up to the crisis, and a pretty significant decline, a couple of $1 trillion decline in Eurodollars right after, during and after the 2008 crisis. If we go over to the left-hand panel, we can see why. And here's the story. This is the LIBOR OIS spread. So the LIBOR is we could have a more updated conversation about LIBOR. Some funny business was exposed as a consequence of the years of crisis, and so LIBOR is not a great reference point anymore. but it was a fine reference point for 2008. And so LIBOR is a measurement of the offshore dollar rate, and OIS is a measure of the onshore dollar rate. And so what we see in this picture, which is actually a version of one that came from a paper Perry and I worked on in 2009 or something like that, 2009, 10. What we see here is that normally the interest rates are right on top of each other, right? So onshore OIS rates and offshore LIBOR rates at equivalent terms have basically no gap. In the middle of 2007, as the crisis got going, a gap began to open up, which meant that there was a big premium to you had to pay a lot more to move your money onshore, right? The premium opens up. We could say that onshore dollars suddenly became a lot more valuable relative to offshore dollars. And that was a pretty good measure of the intensity of the crisis, rising at the beginning of the crisis in 2007, spiking in September of 2008, and resolving over the following months back down to a normal level of zero. So, what we could say is that that big spike slowed and then reversed the growth in eurodollars as it expressed the significant premium for onshore dollars, the more moneyness of onshore dollars, and people did what they could to get their money out of the offshore world and into the onshore world. Let me wrap up in the next couple minutes with this, and this is really the punchline. So I thank you for staying with me all the way here to the end. This picture is back to stablecoins, and so we're trying to close this argument out. Where we come from is to say, okay, we understand stablecoins as financial instruments. We have monetary priors, which lead us to think that there's something like eurodollar deposits. We've seen how gaps in offshore rates govern the flow of dollars between onshore and offshore. How can we learn something then about the world of stablecoins? What we found, and for the details of this, I'm afraid you're going to have to go to the paper, but what we found is convincing evidence in a couple of disparate sources showing clearly that there's a story which is quite coherent and really explains a lot about the emergence and growth of crypto. That's really about harvesting various arbitrage opportunities in first and foremost between different venues in which you could trade Bitcoin, and then later on Bitcoin derivatives, which were available off-chain, but also then eventually on-chain. And then we could see that opened up into the broader world of various decentralized finance, on-chain, DeFi kinds of investments. And all of this was governed by harvesting of interest rate spreads. This is not the story that that people within the crypto space tell about the growth of crypto, because it really, and I think the reason is that it really hinges on the relationship between onshore and offshore. And crypto true believers tend to tell a story about creating a new monetary system free of intrusive interventions. We think that a better story is a crude and very familiar profit motive, which has more to do with leverage speculation and harvesting interest rate differentials and arbitrage opportunities, both within the on-chain space and also between on-chain and off-chain. And as a way to make that point as clearly as possible, this graph tries to replicate the analysis of the previous graph. Let me walk you through it. The greenish line is measured on the right-hand scale. That's the gap between Aave lending rates and SOFR. SOFR is an off-chain regular overnight repo rate, and Aave is what we took to be a very money-like, quite comparatively low risk lending protocol on-chain. And so we think that should be sort of a floor for all of the interest rates available for funds in the, Aave rates should be a floor for all of the interest rates available in the on-chain space. So that's the green line measured on the right-hand scale. And on the left-hand scale, the red and blue lines, total volume of stablecoins outstanding, market cap, as you call it, if you think of them as speculative investments, as we write here. So what's the point? Well, that the green line shows a positive and quite large spread of something like as high as 10 percentage points falling over the course of 21 and 22, but still positive and a spread that anyone would be happy to earn if you could leverage free money. The off-chain rates were basically zero there. So in various ways, leverage speculators could borrow money off-chain at basically zero, put the money into stablecoins, and use it to get, at the very least, to get the Aave rate, which is maybe 2 or 4 or 5 or 10 percentage points above zero, and so that's free money. It's a very straightforward arbitrage opportunity. And while that arbitrage opportunity exists on the whole left half of this graph, stablecoins outstanding were rising. Now the vertical lines show the Fed hiking rates. And so hiking rates also pushes up SOFR, which lowers this spread, which you can see then becomes negative after about the third rate hike in the middle of 22. So now the spread is negative, which means what used to be a profitable arbitrage is now a loss-making arbitrage. And lo and behold, the level of stablecoins outstanding begins to fall as the arbitrage argument leads us to suspect that it should. So it's an arbitrage story between on-chain and off-chain. When that arbitrage is positive, people poured money into it, and we can explain a lot of the rise in stablecoin usage that way. When the arbitrage becomes negative, then it falls. And I have an update to this graph, which if you read Soon Parted religiously, as you should, then you already have seen this. But I updated the data after our paper came out because a couple of people said, hey, but now Tether issuance is increasing again. How do you explain that? And so I ran the data again, and the answer is I explain it by saying that the spread has become positive once again. And so checkmate, our story is correct. And I don't suppose that it's that simple, but I do think that, but I was satisfied to see the answer hold up in out of sample analysis. And I think that we have at least a very large part of the story here. Really simple. It's an arbitrage opportunity. When that arbitrage was positive, stablecoin issuance rose. When it became negative, stablecoin issuance fell. When it became positive again, issuance rose once again. So I think our familiar analytical apparatus gets us a very long way in understanding stablecoins and therefore the crypto space more generally. I'm going to wrap up. I have always more to say, but I'll direct you to the paper and I'll try to leave at least a couple minutes for comments. The takeaways are going to be easy for these folks, for you folks in this audience. We think the analogy to Eurodollars is a good one with a caveat that I mentioned, and we would encourage this lens as one that people can use in continuing to think about stablecoins. It's not only stablecoins, but also the crypto technologies, crypto ideas, in particular tokenization, seem likely to have another life. We won't call it crypto; it will be outside of the crypto quote unquote space, but actually similar tech rebuilt within the regulated banking system. And so the ideas may still be valuable there as well. We can see there's some hierarchy going on. I've made that point, I think, clearly already. Any hierarchy eventually is going to be tested. That's how we know, and that's how we find out how they were put together, is because one day things get ugly and we find out how it was all working. So we think this analysis maybe can suggest, can at least guide or be an input to whatever we do when we wake up one day to find that stablecoins are coming apart. There are other takeaways, and maybe we can get into them in the questions. I thank you for your attention. Two things coming up. One in the near future. One probably farther out. Tomorrow. Oh, here's the time. I put it in the slides. 11 a.m. Eastern, which is 5 p.m. Central European time. If you're somewhere else, I'll let you adjust with Professor Luca Fantacci. We're calling that the political economy of tokenized money, which is my title. His paper has a different title. I'll share that with you tomorrow, and certainly encourage you to read it. And Iñaki and I, just the two of us, so Perry as a spectator on this one, have a project which is trying to make the following point: that tokenization, which is creating tokenized representations of financial or non-financial claims, tokenization is itself a market-making function. And so when I was in Basel, we worked on that idea, and eventually there will be a paper which we could consider in some way a sequel to this paper. I will stop there. I think I did okay on time. Thank you for your attention, and I'm certainly happy to respond to your questions. I'll let Jay moderate, or if you've got someone else in mind. Thank you.
Yeah, thank you very much, Dan. Due to the going over time in the previous session, we only have about 7-8 minutes for this discussion. So I would say, if you have a question, raise your hand and make a very brief point, and then we give Dan 2 minutes at the very end to sort of respond. I see Jorge's hand is up. You go first.
Sure. Hi, Daniel. Thanks for the talk. So that said, I wanted to ask about second layer technologies and how would they fit into the description of on-chain versus off-chain. Like if offshore dollars are analogous to on-chain in the case of stablecoins, where would you place things like the Lightning Network being on the second layer of a Bitcoin network? And on the hierarchy of money, it should also apply. I don't know if you have any thoughts on, for example, Nick Batia's book Layered Money, which cites Mehrling's observation of money is inherently hierarchical. And it describes, you could say, the second layer as the offshore version of the first layer, which is on-chain. So I don't know if you could reconcile those two. Thanks.
Great. Salim, you have your hand up.
Okay, it was excellent presentation because it is a topic which aligned to my research topic also. I'm working on it in stablecoin because here in Pakistan, the people adopted the stablecoin because of the inflation and macroeconomic instability. And so they're threatening the monetary policy here in upcoming years in Pakistan because it's offshore dollar, as you mentioned. But my question is that if we see the stablecoin basket, if I'm taking even Tether, which is backing by the securities, not by the cash dollar, so it is also vulnerable to the event of runs because if you don't have the liquidity, because securities has a maturity. So if there is a panic situation, even Tether can not tackle that run. As you talking about Luna, Terra Luna, that there is no backing. But I'm trading crypto since 2017, and I follow these all events and also lost money in Luna Foundation, which I have invested. But there is a Luna Foundation guard which is holding Bitcoin for the just like a haircut situation on the run on the Terra Luna. So they liquidated that Bitcoin to stop that to pick this Terra Luna and to pick to the dollar. But there is a panic out there, just like 2008 we have seen. Once there is a panic created, so nothing if you don't have the liquidity, so you can't stop that run. So in my question is that there is no technical plot, I think, in the Luna. There is a panic which even EIG like one cannot tolerate. So what's your point on that on this that because it is a decentralized nature and not backing by the US debt, so that's why it's collapsed, and all other stable coins are backing by the US debt, so they are survived. So this is my comment.
Thanks, Salim. Let's take Anush next for now.
Thanks, thanks, Dan. That was really great to hear that. I haven't had a chance to look at the paper yet, and I was doing so as you were presenting a little bit. So these are off the cuff, but a couple of questions. One is that I think, you know, in general, crypto is, I think, interesting because, as you said, in the end, some of this stuff will migrate over to TradFi. But I think also as things break or don't break, we learn more about the traditional system. So one question that you know, occurred to me, maybe this is the subject of a next paper, is to what extent, not if this is a good replacement for money or even, indeed even money market financial instruments, but To what extent can algorithms mimic the dealer function? Can we algorithmize a dealer function? And can algos do that? And if not, why not? And then that tells us something about the institutional nature of the dealer function. So that's and maybe that's just by way of speculation. The other thing is about I understood in the end why you made the Eurodollar analogy as opposed to the money market mutual fund analogy. But is it the case that Eurodollars grew because of arbitrage opportunities, or was it because global cash pools, being what they are, you know the Zoltan story better than I do, they had to be parked somewhere, right? So so not really arbitrage opportunities, but and on the flip side, they didn't break because arbitrage opportunities went away. Eurodollars broke because the dealer banks who were doing the arbitrage to create the parity that you're talking about was sideswiped by the mortgage crisis and you know and the sort of bad assets that were exposed on the banks there, and so their dealer function were infected by other bits of the portfolio. So I understand the arbitrage mechanics there, but both the rise and the crash of Eurodollars have a slightly different story, it seems to me. So I wonder how you react to that. Thanks.
So then I think let's go back to you. And there's a lot of chat in the comment section, so we might reply there directly then.
Sure.
Go ahead.
Thank you. Thanks, Jay. Thanks for the questions. So Jorge, so let me say I am a monetary economist. That is, I have a Ph.D. in monetary economics, so that I stand on. I certainly know more than your average Joe about programming and computers, and I've used that part of my life to understand crypto. I do have a limit for it, and so there are things that even I don't know. But what I would say about second layer, to the best that I'm able to respond to it, I would say that I think an analogy is sort of like another step offshore, which we don't have in the offshore system. But I think the analogy I would say is we go from off-chain to on-chain. That's like going from onshore to offshore. And then if it were possible to go even further offshore, off yet another shore, then I think that is what we're talking about with second layer. We came across some examples like BitMEX perpetual futures in the crypto space, which are, we shouldn't call them on-chain exactly, because the contracts are they're not running on the Ethereum virtual machine themselves. They're running on somebody's computers. But you have to have on-chain instruments in order to use them. And so that's another way that you can be sort of offshore and then some. Excuse me, offshore and then some, right? Offshore and then offshore again. So let's not push the analogy farther than it should go. But I guess I would say the second layer, that's how I would respond to the second layer. And if you're working more on this, then I would be super interested to hear where you go with it. Maybe you have better answers than I. You mentioned also a book which I haven't read, and so if you could get me the link to that, I will be interested in checking it out. But I'm not going to respond to that at the moment. Salim, thank you for your questions. I think the point about Tether is one that I agree with very strongly, which is namely that Tether's own narrative about its stability has everything to do with backing, and that's really a solvency argument. The value of the assets is this. It's greater than the value of our liabilities, therefore we can sustain par. But as we know, the issue is going to come when the moment arrives for redemption, when everybody wants to turn those tethers into dollars, and Tether's got to sell them all at once. And most of the time it can do that. That's why it's chosen the assets that it has. But normally, in normal times, that doesn't create any kind of problem. Tether's not going to fail on an ordinary day. It's going to fail on a day when market liquidity in the markets in which it's involved goes away. And this, I think, is the fundamental feature of the financial world that they haven't perceived, which is that they're assuming the availability of market liquidity. And even in treasuries, market liquidity can cease to exist. And treasury market is big and important And so that's only going to happen on a very interesting day, and that's when Tether would encounter the problem. And the bigger they get, the more interesting that day will be. So I think we're mostly in agreement on Terra Luna. You were pointing out that there were some funds that Luna had, so something that we could write on the asset side of that. As I understood what you were saying, something we could write on the asset side of that balance sheet. And I would certainly accept that if you know that institutional fact to be true. I have no reason to doubt that. But the tokens themselves were not redeemable directly as a there wasn't a mechanism by which you could redeem the Luna tokens to force the sale of the Bitcoin. Somebody had to do that, and so it's kind of one step removed from the protocol. And so I would say again, it was a scramble for market liquidity. And the big point that I think I would like people to take away about Terra and Luna is that the algorithm itself seemed very clever to the creators, just as the Uniswap algorithm seems very clever to its creators. Those algorithms seem very clever, but they assume the existence of market liquidity. And the way that they show that assumption is by putting price in the denominator. So they make price do all the work, and then they ignore the possibility that price could go to zero. And that is exactly what happened with Luna. And there's no reason that it couldn't happen with an automated market maker like Uniswap. And although Terra was discredited, it wasn't really discredited for this reason. And that's why I keep talking about it, because I would like people to understand. To Anush, well, let me stay on the same question, because one of your questions was, could we algorithmize the dealer function? And I think the answer is no, but we probably could make algorithmic the inside spread kind of operation of the dealer function, right? So I think on a normal day, you could probably set it and forget it, right? And say, these are my inventory, just use trainer. These are my inventory limits. These are my prices, and let the algorithm go up and down. And that would be great. And but that's not the extent of the dealer model, right? The extent of the dealer model involves also the outside spread, and that's essential. You can't give to an algorithm the control of what happens at the outside spread. Why? Because what's essential at the outside spread is that somebody be able to somebody still have the position to act with discretion. So I always come back to Minsky on this, and I've once or twice tried to make the point to sort of revive this idea from Minsky that is frequently lost. Minsky said liquidity is equivalent to discretion. That when we say the central bank is the holder of the liquidity function, the center of the liquidity function in an economic system, that the reason that's equivalent to saying the central bank retains discretion to act even when everybody else has lost it. No, it doesn't need to be an absolute statement. Maybe also the central bank could lose discretion to act. That could also happen. But in a crisis, the reason the Fed can create dollars is because it can do so without asking anybody else. It has discretion. What the 2008 crisis also showed was that when the dealing system broke down, so all the dealers were pushed all the way to the outside spread, all at the same time, it became a funding liquidity issue. And the Fed was the only one able to solve it, which they did in ways that this audience understands, by creating a large amount of funding liquidity. And dealers were able to turn that back into market liquidity and make markets work again. That's an extreme statement of the idea that somebody has to have discretion, has to act with discretion, and have the discretion to be able to use it at the moment when the dealer system is pushed to the outside spread. And so I think you would not be, you could maybe algorithmize the inside spread operation, but when you get to the outside spread, discretion is the key ingredient, and algorithms and discretion are the opposite of each other. And so it would break down. And I think that people will try to make this work. That's basically what Terra Luna was doing. That's basically what Uniswap does. And the idea has been tried in other ways over the years as well. Sorry about that. The idea has been tried over the years in other ways as well. and one day it will be tested dramatically, and it will fail.